So when there is turbulence and volatility in the stock market, many investors like to run to safety. And oftentimes that means dividend stocks. Problem is, most of the time when people think of dividend stocks being safe, they think of low yield. However, the good news for you is I've got a list of 5 dividend stocks. 5 that are super safe based solely on the fact that their dividend has been paid for at least, wait for it, 50 consecutive years. And the best part is all 5 of these dividend stocks, having paid 50 years in a row and raising their dividend every year, they're yielding right now more than 3% and some of them more than 5%. Alright guys, the first dividend stock we're going to talk about in this video is Universal Corporation, ticker symbol UVV. They are in the consumer staple sector of the economy, specifically the tobacco industry. Universal Corporation is broken up into 3 distinct business segments. We have Universal Leaf Tobacco, which is the processing and selling of a variety of different types of tobacco. Then we've got Universal Ingredients, which is their diversification into the agricultural business space. And then we have Universal Enterprises here, which offers products and services ranging from traditional laboratory testing of raw agricultural products and the testing of agricultural byproducts that allows them to take advantage of the possibilities presented by evolving new markets. Universal Corporation has been paying and increasing dividends consecutively every year for 51 years now, which makes it not only a dividend champion and a dividend aristocrat, but also a dividend king at 50 plus years. As of July 25th, the price per share was $55.80. That's got a 1, 3, 5, and 10-year growth rate of 1.3%, 3.6%, 7.9%, and 4.9%. Now I recognize that 1.3% is not great, especially in a high inflationary environment, but the name of the game here is super safe, long, consistent track record of raising the dividend. And that's what you get with Universal Corporation. You're not going to have high dividend growth, though you can see over the past 5 to 10 years that the dividend growth rate has been very good. The dividend yield for Universal Corporation is currently 5.66% against a historical 5-year dividend yield average 5.35%. which is a current 5.5% discount. And then we have the payout ratio based on the most recent year, based on free cash flow, which we know is critically important and a better measure than net income, and that is 44.51%. And the dividend is paid quarterly, and that annual dividend is $3.16 per share. Okay, number 2 on the list that we're going to talk about is Leggett and Platt Incorporated. Ticker symbol is LEG. And they're in the consumer discretionary sector of the economy, specifically household durables. Their business history spans over 130 years, and they have very distinct business segments. The first is bedding products, specifically springs, specialty foam, adjustable beds, machinery, etc. Second, we have specialized products, from high-performance automated comfort and convenience systems to aerospace tubing, ducting, and fabricated assemblies, and very diversified from the first business segment. And then third is furniture, flooring, and textile products, including the design, manufacture, and distributing of seating components and finished products, carpet cushion, and hard surface flooring underlayment. Leggett & Platt also has a 51-year consecutive history of raising their dividend, which makes them a dividend king. And their price per share as of July 25th was $38.78 per share. You can see a little bit better dividend growth rate record with Leggett & Platt compared to Universal Corporation at 5% for the 1 year, 3.4% for the 3 year, 4.3% for the 5 year, and the 10-year growth rate 4.2%. Now, that's not good compared to the most recent high inflation environment we're in, but based on the long-term inflation rate, it definitely is better than that and outperforms. The current dividend yield based on its most recent price is 4.54%, and compared to its 5-year dividend historical yield of 4.24%, this represents a 6.6% discount on its historical yield. And it's also got a very, very healthy payout ratio based on free cash flow, 46.32%. And again, anytime we have a dividend payout ratio based on free cash flow of less than 50%, we are super confident that not only is it safe right now, but secondly, and maybe even more importantly, we know that it has the ability and the sustainability to grow that dividend just like it has in the past into the future. And then Leggett & Platt has a quarterly dividend, and that total annual dividend is $1.76 per share. All right, third on the list is Black Hills Corporation, ticker symbol BHI. They are in the utilities sector of the economy, and they're involved in multiple utilities. Black Hills Corporation operates Black Hills Energy, which, as it mentions right here, is the business name under which they operate their both natural gas and electrical utilities. They serve over 1.2 million customers in 8 different states. Now, Black Hills Corporation has a 52-year history of every single year raising their dividend. Their price per share as of July 25th, $73.18 per share. I really like Black Hills Corporation's steady and consistent dividend growth rate. 5.5% over the 1 year, 5.8% over the 3 years, 6.4% on average over for the last 5 years, and on average over the past 10 years, 4.7%. Their current dividend yield is a little bit lower than the last two at only 3.25%. However, based on their historical 5-year yield, it's 3.12%, which means we're getting a 4.1% discount if we buy today. Now, you'll notice their payout ratio based on free cash flow is negative 19.15%. Now, here's the deal. We know that utility companies are very capital equipment intensive, right? They have significant equipment and facilities they have to not only operate, but they have to maintain them, and that requires a lot of capital. Here's the deal. I can't in good conscience say that this is a safe dividend company, despite the fact that it has a rich history of 52 consecutive years of raising that dividend. Now, are they likely to cut their dividend anytime soon? Probably not, though I can't guarantee anything. When a company does not have enough free cash flow to not only pay all of their expenses, but also to pay a dividend, that is a warning sign to me. It means that if they're doing that, they're either paying that dividend with cash that they have on hand, which is not sustainable for the long term, or maybe even worse, they're borrowing money to pay the dividend. I can't in good conscience say that that is a great idea, because it's not a good idea. It's a reality for some utility companies at times. So it's not a bad idea to invest in this company, but it's not one I'm going to, in good faith, say, it's one I own myself, because I don't, and I don't have plans to buy it. But again, 52-year history, likelihood of raising the dividend in the future, yes. For how long? I don't know. That dividend for Black Hills Energy is paid quarterly, and it's currently $2.38 annually per share. You'll also notice here that the historical free cash flow per share has been negative for the trailing 12 months, as well as the last year, the year before it, and the year before that as well, though it was positive in 2018. All right, number 2 on the list is one we've talked about, so we're not going to spend a lot of time here, and that is 3M Company. Ticker symbol MMM. It's in the industrial sector of the economy. We've talked about 3M before. I'm not going to talk about it in length again. Just know that they have a ton of products that many people use on a daily basis. Like, again, talked about it previously, not going to go into it in more detail here. A 64-year dividend streak, though, a very rich dividend history, and their current price per share as of July 25th, $134.53. Their 1-year dividend growth rate has definitely slowed, and that has also impacted their 3-year growth rate, since it's an average, which is 2.4%. Though their 5 and 10-year histories are much better at 5.7% and 10.2%. In general, one of the things you should be mindful of, it might not be the only determining factor, but to be mindful of, is when we have a dividend growth rate that continues to slow over the 10, then the 5, then the 3, then the 1 year. That could be concerning, that the just overall trend in dividend growth rate is going down. So for me personally, I like to look for companies that are much more steady on their dividend growth rate. Their dividend yield right now is 4.43%, which is much higher than their historical 5-year dividend yield of 3.24%. A 26.9% discount. And their payout ratio, given their 64-year history, is safe at 61.44%. And their dividend payment is quarterly, and their annual dividend is $5.96 a share. Again, we talked about in the previous video that there are some concerns regarding current liabilities and lawsuits. I'm not going to go into more detail here. Go check out the previous video, which I will link down in the description below, and I will leave as an end card for the end of the video for those of you that didn't catch the last video. In my mind, though, 3M's still a great buy. Long super history of paying the dividend, one that I don't own in my own portfolio right now, but it's one that could be added here soon because of that deep discount on their price per share. And lastly, the number 1 company we're talking about here, the one with the longest dividend streak, is Northwest Natural Holding Company. NWN is the ticker symbol. They're also a utility, and specifically a gas utility, with a 66-year dividend streak of paying and raising the dividend every year. Their current price per share is $52.69 per share. Northwest Natural Holding Company is headquartered in Portland, Oregon. They've been doing business for over 160 years in the Pacific Northwest. They operate the Northwest Natural Gas Company, Northwest Natural Renewables Holdings, Northwest Natural Water Company, and other business interests. They provide natural gas service to approximately 2.5 million people in over 140 communities throughout Oregon and Southwest Washington. Their current dividend yield is 3.66%, and their historical 5-year average yield is 3.31%, which is effectively nearly a 10% discount, so that's a good deal. But again, like we saw with the previous utility, their payout ratio based on free cash flow is no bueno. We're at negative 81.78%. And again, this means that the dividend they paid out is far exceeding the amount of free cash flow they had available, because they didn't have any free cash flow available. They did not have any money left over to even finish paying their expenses, but also to pay out their dividend, which means they either used cash on hand or they borrowed money to pay this dividend. That can and should be an alarming fact for you as a dividend and cash flow investor. Their dividend is paid quarterly, and their annual dividend is $1.93 per share. And again, in looking at the historical free cash flow per share, we can see that it has been negative every year except for 2018. So again here, guys, if your biggest concern as a dividend cash flow investor is having solid, reliable, safe dividend stocks in the portfolio that have pretty good yields above 3%, as high as 5.65%, then these are 5 great examples of stocks you can take advantage of today. Now, for me personally, it's not quite aligned with my strategy, and I'm not quite as conservative to say that I need these types of super safe, long-standing companies. I'm willing to take a little bit more risk. I'm a little bit younger, to be honest, right? So my concerns are a little bit differently aligned than some cash flow investors out there. Some of you guys just really want safe, reliable, set it and forget it, check it on it maybe once or twice a year to make sure that they continue to raise their dividend, in which case these might be great examples of stocks to own. Make sure to leave your 2 cents down in the comments below, guys. I love getting your feedback, hearing your ideas for future videos, getting feedback on how this video went. Did it suck? Did you guys think I should have done something different? Make sure to leave your 2 cents down in the comments below. I can take it. I got a thick skin. And I want to, most importantly of all, make better videos for you guys in my audience. That's all I got for you guys in this video. Have a great rest of your day. And please continue to stay healthy, both physically and financially. Have a good one.